looking at the past. It's what you do with the future. So it may be too late, but I'll talk about some of the things that have gone on this past year. The biggest tax change we had was something called 100% bonus depreciation. Okay, 100% bonus depreciation, coupled with the first time in tax history that you could actually write off bits of real estate. Okay, so what is 100% bonus depreciation? It's a depreciation of a fixed asset, of a big thing, big tangible thing, that you can write off the entire thing in the year that you start using it. Now, many of you already know about something called Section 179. I don't like to talk about code sections very much, but Section 179 is one of those that, if you're familiar with getting your taxes done, we may expense things on Section 179, just like 100% bonus. Okay, the big difference between Section 179 and 100% bonus, this new law that happened last year, actually it happened on September 9th, 2010, all the way through December 31st, 2011. The biggest difference is for 100% bonus, there is no limitation. Okay, so there's no limitation about how much you can expense. That's one big difference. The second big difference is there's no depreciation recapture. Depreciation recapture, what is that? Okay, I'm going to take two situations, one under Section 179, one under 100% bonus. Let's take a vehicle, because when our lawmakers enacted 100% bonus, they didn't realize that what they were doing is covering heavy vehicles. They had no idea. If they knew that, they would have made an exception in the law. They didn't. They were fast. They were running through things. They didn't realize when they passed 100% bonus that they were covering vehicles with a loaded vehicle weight of 6,000 pounds or more. That means all the people in them and the car itself, or truck, is 6,000 pounds. Okay, so let's take two entrepreneurs. One of them, let's say it's December 15th, 2011. We're going to turn back the clock. One of them buys a big heavy vehicle. They both buy big heavy vehicles, same ones. One of them uses Section 179, the other uses 100% bonus. Okay. It's the last hour of the year, December. They both buy these vehicles. They want to use them for business, and then they're going to probably let their wife use the vehicle after they use it for business in 2011. Okay, so let's take the Section 179 guy first. He buys that vehicle, he uses it for 15, 16 days in 2011. Me as the tax guy, I write off the entire vehicle on Section 179. He gets a big deduction, no matter what the cost of the vehicle is. So it could have been a Porsche Cayenne, for instance, over $100,000 car. Let's use that. I'll say it's over $100,000 Porsche Cayenne. So the guy, I write it off, and then January 1st, he says, oh, that was a good write-off. I'm going to give it to my wife to use now. Okay. If he gives it to his wife to use, then that's taking that's subject to what we call depreciation recapture. It means he has to pay income when he gives it to his wife. So he deducts it in one year and he gets back income in the other year. Almost all the depreciation that he claimed is going to be coming back. Okay. Let's contrast with that 100% bonus. The guy that's using the 100% bonus would have deducted the whole thing, and there is no depreciation recapture on giving it to your wife, using it for personal use. So what my clients have done, some of them, when they found out about this rule, is they did exactly that. They said, honey, do you need a new car? Yes. Let's go buy a vehicle. We'll get 100% write-off. We'll use it for business for 15, 16 days. And then I'm going to give it to you January 2nd or 1st or whatever it is. And that is the way to do it. That's the unusual thing about this 100% bonus. No depreciation recapture. And you may see a lot of, if you notice, you probably see a lot of heavy vehicles, new heavy vehicles around lately, and that's because of this 100% bonus. Okay. The second thing that this law did, which I mentioned just briefly, was to be able to write off real estate. So normally real estate, you buy it, and for commercial property here, 40 years, for residential, 27 and a half. If your property is overseas, in India for instance, then we write it off over 40 years. Okay. This law about writing off your depreciation allows you to write off $250,000 of real estate improvements. So that's a great thing. It's the first time I've ever seen anything about writing off completely your real estate. Usually the best thing we can do is something called cost segregation, where we break the components of the building into fast depreciation categories and get a faster write-off. But this law last year, this allows you to write off $250,000 per entity for real estate. Okay, so those are the two big ones. Now the kind of bad news about last year is that.
Jeff?
Yes.
Just a question, just speaking on behalf of the crowd, I'm not sure how you structured your talk, but if you could, I think if we were to divide this room, we would possibly, there would be individuals that would be purely salaried executives. There would be individuals who just own businesses.
Okay.
Possibly a third category of people who are salaried but also owning businesses, right? So,
okay, we'll get to those too. Okay. Thank you.
So I was just wondering if you could contrast, some common deductions that are known and that are unknown for each of those categories. So
Right. So, part of the bad news about last year is that as far as tax planning goes, is that the Bush tax cuts were extended, which means we're dealing with mostly the same set of rules that we did before. In general, 2011, they extended the tax rates all the way through 2012. And 2013 is our big year for change, for a number of things. So I would like to talk about some, on that line, some general things that people just miss. I have many clients, many of them are from India, Pakistan, or other places, and these are things that people just generally miss on their tax returns. Immigrants, basically. So the first thing that we all, that everybody's aware of, probably with all the media hype, is the FBAR rules. So in case you've been sleeping, the FBAR is the Foreign Bank Account Compliance Rules. It requires you to file a TDF 9022.1 for every foreign account that you have. Okay. So there are some definitions that have to go with this, because many people think that they don't have a filing requirement when they really do. Okay, so we have to back up and look at the history of why these are here. So the FBAR rules were originally designed to catch criminals, money launderers, drug dealers, people like that. After 9/11, they gained a little more importance because they were involved in trying to source terrorist financing. Okay, so and then in 2008, UBS, a Swiss bank, received what's called a John Doe summons for the names of U.S. persons investing in that Swiss bank account. Okay, a lot of legal stuff went back and forth. Basically, UBS lost. They handed over roughly 5,000 names of U.S. persons. Okay, shortly after that, there was another John Doe summons issued to HSBC, India. Okay, same thing is going on there, and some high-profile people did get caught with that. The main difference between the FBAR rules and the other rules is that the FBAR rules are under the criminal part of the tax code. That's very important to understand. The criminal part, meaning you can go to jail, you can lose your liberty for not reporting your foreign bank accounts. Okay, so now that I have your attention, that's right. When we find on filing with our clients, most of those that have foreign bank accounts that we entered them into the amnesty program, we found out that when they declared the income from their foreign bank accounts, the tax, the actual tax they saved was either none or negative. They actually got a write-off from declaring their foreign income. Okay, so it's not a big deal to declare your foreign income, and it's what you're supposed to do. And it's a criminal thing not to. So I've always encouraged my clients to declare their worldwide income, which is what you're supposed to do, and then take a credit for foreign taxes paid. A lot of these guys have money that they've sent back to buy a house or an apartment or something, and the way it turns out in India, usually the rent income is so small because the asset appreciation is so big that we get a large write-off for depreciation and other things, and then the income is, since it's so small, we actually create a tax deduction by declaring the foreign income. Many of you that have foreign bank accounts that have income, you have paid Indian taxes, and you never took a credit for those Indian taxes on your U.S. return. So, best thing to do is to declare your foreign bank accounts. Your foreign bank account is an account that you hold, that's in your name. It's an account that's in your name for the benefit of somebody else. It's an account that is in somebody else's name for your benefit. It is a provident fund. It is the cash value of life insurance. I think I got them all. Okay, so those are things that are foreign bank accounts.
Is life insurance a foreign bank account?
It depends on what kind of life insurance. If the life insurance has a cash value, then yes.
But that cash value is not yet a tangible value. In India, it expires around, they redeem it around 50, 30 years, whatever.
Right. So what we're talking about is we're not talking about taxes yet. We're talking about whether or not you have a filing requirement that could be a criminal offense if you don't report.
What if it doesn't earn income and it was something that it was an old account that you had before you came here?
Okay, if it doesn't earn income and it was an old account, doesn't matter. We're not talking about taxes. We're just talking about reporting what you have. Remember, the point of this was to catch criminals. So there's another form that we're going to get to that's designed to catch your taxable income. Okay. For most of the amnesty program, what they want to do is they want to bring people in. In order to qualify for the amnesty, most people will have to declare whatever income they had. So there's a little tax tie-in to the amnesty program for the FBARs. But the main point is to declare what you have. If you don't do that, it's a crime. If the amount is over $10,000 in the aggregate at any one time during the year. So you can see how a guy who's maybe he's thinking about a second home. Maybe he's going to go back, and he wants to have a house to go back to, and he's having a house built, and he's just sending money back. And at any one time, the money he sends is over $10,000. That's an FBAR filing requirement. That's a very common way that people get into the FBARs. And when I say, even though it's criminal not to file one, you should just file one. It's not that big a deal. We personally charge $65 to file a TDF 9022.1. I'm sure other preparers do something similar. If you want to do it yourself, you can try. But given the nature of the crime part, I recommend that you actually get a professional to do it for you. Okay, so that's pretty much it. I think you're sufficiently paying attention for the FBAR part.
Jeff,
Yes.
when you say about 10,000